To make the most of your old age security benefit, or OAS, you need to understand how it works and the impact your other income can have on the amount you receive. My name is Nick Hearne, Financial Advisor and Portfolio Manager at RGF Integrated Wealth Management. And in this video, I'll explain how your OAS benefit works and how to compare starting ages by calculating your break-even age and considering the implications from clawback. Unlike CFP, which is based on your earnings history, OAS is a government-funded benefit that you qualify for just by living in Canada. To be eligible for the maximum benefit, you must have lived in Canada for at least 40 years since the age of 18. And as long as you've lived in Canada for at least 10 years since the age of 18, you'll receive a prorated benefit. OAS is adjusted to the cost of living quarterly, and your benefit increases by an additional 10% when you turn 75. You're eligible to start your OAS benefit at 65, but you also have the option to defer for a higher benefit amount. And for every month you defer, your payment increases by 0.6%. The longest you can defer is to age 70, which works out to a total increase of 36%. Now, this is slightly different than CFP, which increases by 0.7% for each month you delay. This adds up over time, and at age 70, the total increase from delaying CFP is 42%. So all else equal, delaying CFP provides a larger boost than delaying OAS. A break-even analysis is a good place to start when deciding the right age to start OAS. This analysis estimates your break-even age when the higher payments from deferring catch up to the earlier missed payments. Since OAS payments are indexed quarterly to the cost of living, your analysis needs an assumption for inflation. And we also need to think about the opportunity cost, as $1 today is worth more to you than $1 tomorrow. And we'll account for this by making an assumption of investment return. Now, this can vary widely depending on the person, and so for our analysis, we'll need a volunteer. Enter Janet. We'll use 2.1% for our inflation rate and 5% for opportunity cost, as this is the target return of Janet's investment portfolio. And putting this all together, we arrive at an estimated break-even age of 88. So based on these assumptions, if Janet lives to at least age 88, delaying to age 70 will provide her with the greatest lifetime benefit. Well, maybe. There's one pretty big caveat to all this, and that's OAS clawback. OAS is a government-funded social benefit and can be reduced depending on your income. For every $1 that your income exceeds the OAS clawback threshold, 15 cents of your benefit is clawed back. This threshold is adjusted annually to account for inflation, and for 2025, the amount is $93,454. It's an income of just over $150,000 that you start to see the full benefit amount being clawed back. The CRA uses your net income, line 23,400 on your tax return when assessing clawback. And keep in mind, there's a delay, as the CRA doesn't know your taxable income until you report it. From January to June, OAS clawback is assessed based on your taxable income the year prior to the year before. Your taxable income for the prior year is considered starting with the July payment. Because incomes often vary throughout different stages of retirement, you need to compare starting ages based on how much you expect to receive each year, not how much your benefit is. For example, it's an easy decision to defer if you currently have a net income over $150,000. Regardless of whether you start payments or defer, you won't be receiving any OAS. So by delaying, you'll increase your future benefit without actually giving anything up. This is a pretty common situation for high income earners who continue to work past age 65. On the other hand, it's an easy decision to start OAS when your income is currently below the clawback threshold and you expect it to exceed the threshold once you're a few years into retirement. You'll receive a benefit by starting OAS, and there's really no upside to a higher future benefit if you're not actually going to receive it. This is the most common among individuals with large RRSPs that plan to wait until age 72 to start withdrawals. Now, this situation can be more difficult to identify, as you need to have a good idea of what your taxable income will be throughout retirement and not just in the current year. To summarize, the break-even analysis is a great way to compare starting ages, but you need to consider the amounts you expect to receive, which may be different from the benefit amount. And you also want to consider how it fits with your retirement plan. If you have a greater need for cash flow earlier in retirement, starting at age 65 will provide you with additional cash flow when you need it most. But if you're concerned a long retirement could mean you outlive your savings, then delaying to age 70 may make the most sense. Thanks for watching. If you found this video helpful, please consider liking and subscribing for more tips on retirement planning.